Unemployment has hit its highest point since 2017, hitting 6.6%, and has caused a lot of people to ask, what does this mean for potential rate cuts from the Bank of Canada? We've seen lots of news articles saying that the bank rates are going to plummet and go down really, really quickly, but I think it's really important that we look at historical data to try and get a really good idea and concept of exactly what's going to happen. My name's Miles Noack of the Noack Mortgage Team, powered by Indy Mortgage, and today we're going to take a look at the Bank of Canada and potential rate cuts, as well as unemployment and what the current economy looks like compared to what it looked like last time we saw massive cuts on interest rates. But before we get into this, if you find content like this interesting, or if you're new here, please consider liking and subscribing to the channel so more people like you can see this video, and let's dive into it. So the first thing we want to dive into with this is current unemployment rates and economic context. As mentioned, unemployment hit 6.6% this August, which is the highest non-pandemic unemployment rate we've seen since 2017. This increase came despite the addition of over 22,000 jobs, which is less than the 25,000 that were expected. Notably, full-time employment positions dropped by 43,600, while part-time positions rose by 65,700. What this shows us is that full-time positions are clawing back and part-time positions are becoming available, which is concerning, as generally speaking, these full-time positions are what's going to provide people the financial stability to buy houses, spend money, groceries, and all these other sort of things. Now, the rise in unemployment is really being largely driven by an increase to the labor force participation rate, which means more people are actively seeking employment and unable to find jobs. The participation rate is currently sitting at 65.1%, which is 1% lower than it was in 2017, being at 66.1%. This lower rate suggests that the job market may actually be weaker than what some of the numbers are actually implying. So now that we've touched on unemployment, why it's going up, what's happening, we want to look at historical comparisons to try and figure out if the Bank of Canada is going to drop rates aggressively to counteract this rising unemployment, as they've done so many times in the past. First, let's look at 2017. Unlike now, in 2017, unemployment rates were decreasing from it peaking in 2016, and the Bank of Canada was actually raising interest rates to try and cool down our economy after years of having near 0% interest rates. This is a key difference, as today the economy is really struggling and the bank is already cutting rates. The next time period we want to talk about is 2007-2008. Because the last time we saw unemployment rise this sharply was in the aftermath of the 2007-2008 financial crisis. The thing we want to consider with this is that it was more of an external shock, primarily caused by the US financial meltdown. This time, this economic downturn we're seeing is largely homegrown. Factors such as high inflation, higher interest rates, and a weaker than normal GDP growth are all factoring into these unemployment numbers. Another comparison year we want to look at is the year 2000, when unemployment hit 6.6% due to the dot-com bubble burst in the United States. However, when we look at this, we need to understand that interest rates were actually higher then than they are now, and Canada's economic structure was different. Now that we've taken a look at some historical data, let's take a look at some of the sectors affected by rising unemployment right now. We'll start with healthcare and social assistance, which saw significant growth, adding 157,000 positions over the past year, which contributed to nearly half of all job growth in Canada. On the other hand, professional, scientific, and technical services, utilities, natural resources, and other service-related industries all experienced job losses. Another group we want to talk about is youth workers, generally aged between 15 and 24. They've had a particularly large spike in unemployment, with students having a challenging job market during the summer, and unemployment rising to 16.7%, which is the highest it's been since 2012, excluding the pandemic. So, after all of this, we're going to take a look at some projections and implications. A lot of economists are expecting that the Bank of Canada is going to start cutting rates ridiculously aggressively, or we may start seeing cuts of more than 0.25%, which by all intents and purposes could very well happen. But if we look at the information we just went over, we're in a bit of a different sort of situation than we were before. Canada's current economic situation is relatively unseen in recent history. With no clear historical data for the Bank of Canada to analyze, I think it's really hard to fully predict that we're going to see larger rate cuts from the Bank of Canada. only the Bank of Canada is going to know how they're going to cut rates and when they're going to do it. To summarize this all up, yes, we're seeing unemployment rise, and traditionally speaking, the Bank of Canada has cut rates to stimulate the economy, to make things not get that bad. But if we look at the history behind it, things were very, very different, putting us into a very unique and more homegrown situation than we've been in recent history. So it's really difficult to predict exactly what they're going to do with rates. Are they going to cut rates? Probably. We've seen a downward trend. We've seen 3 back-to-back rate cuts from the Bank of Canada, and we think we're going to see more. But are they going to start cutting ridiculously aggressively based on rising unemployment? Well, that's yet to be seen. Because like I said, this is new forms of data and relatively unique compared to recent history. Now I want to know what you think. Do you think that this rise in unemployment is going to cause the Bank of Canada to start cutting rates really aggressively? Do you think it's going to have a massive impact on rates and the housing market as a whole? Post your comments down below. And as mentioned before, if you enjoy this type of content, please consider liking and subscribing to the channel. My name's Miles Noack. Thanks for tuning in, and we'll catch you next time.